You see that notification on your phone. Mortgage rates just dropped below 6%. Your brain instantly jumps. Maybe this is your chance. Maybe now you can finally buy, refinance, or lock in a better deal. But before you start mentally signing a contract or telling your partner this is our moment, let's talk about what this actually means for your wallet. Because the honest truth is that this good news headline could still cost you hundreds of thousands or even millions of dollars if you don't understand what's really happening. In early 2026, average 30-year mortgage rates have dipped into the low 6% range. It's the lowest level in more than 3 years. That's why headlines are celebrating. Everyone's acting like we just hit the housing lottery. But here's the first shock. At around 6%, you're still borrowing at historically high levels. Rates that feel good relative to last year's 7% numbers are still far above the ultra-low rates of the past decade when sub-3% mortgages were common. And that matters because the difference between a 6% loan and, say, a 4% loan over 30 years is hundreds of thousands of dollars in interest alone, even if the monthly payment feels just a little bit less. Think about it like this. You've been conditioned to believe that lower rates equal cheaper house, but rates are only one part of the cost of ownership. Even if rates dip from 6.2% to 5.8% or temporarily touch the mid-fives, experts say that it's likely to be brief. And unless inflation drops a lot and bond markets behave differently, rates are still expected to stay in the low 6% range in 2026. That means homes might feel a little cheaper on paper, but the total interest you pay over the life of the loan is still enormous. Millions of dollars in lifetime cost won't suddenly disappear just because a headline looks more optimistic. And here's another twist. Many people are watching this rate drop thinking, I'll wait until it gets even lower. That's market timing, and most people lose money by doing that. For years, people with super low historic mortgage rates, think 2 to 3%, refused to sell or move because they didn't want to give up those payments. That created a lock-in effect where housing mobility was frozen. But right now, we're seeing something new. Those holding rates above 6% now outnumber those with sub-3% rates. That means the lock-in effect is beginning to fade. More people might sell and more houses could hit the market. Sounds good in theory. More houses, lower prices. But in reality, prices are still high and inventory remains tight. So rate declines alone don't magically make housing affordable for most people. Now let's talk personal finance, not market headlines. If you're renting and waiting, hearing rates below 6% can feel like your cue to stop waiting and buy. But waiting for the perfect rate could cost you years of lost investing gains, because those months or years where you save and invest could be far more valuable than shaving a small amount off a mortgage rate. A tiny rate difference often pales in comparison to compound returns you could have gained if you invested the cash instead of tying it up in a house that's overpriced because of low supply. If you bought already, you might worry you locked in too high a rate. But many homeowners have rates that were even higher over the past couple of years. Refinancing might make sense, but only if the total refinance savings outweigh closing costs and the time you plan to stay in the home. Refinancing is not free. It often carries thousands of dollars in fees that can wipe out the benefits of a rate drop unless you plan to keep the loan for a long time. If you're thinking of buying, the truth is, lower headline rates may improve affordability slightly, but they don't solve the real problem: home prices plus limited supply. Even if rates dip a little, the monthly payment difference between a 6% mortgage and, say, a 5.5% or 5% often is much smaller than the increase in purchase price most buyers end up paying because everyone else acts the same way. So, instead of timing the rate, you could end up timing the market wrong. Here's what nobody on news networks tells you. Mortgage rate declines can temporarily improve affordability, but they don't fix home prices. Demand increases when rates drop, which can push prices even higher. A small decline in rates might save you an extra few $100s a month, but your wealth trajectory depends on everything else you do with your money. Your opportunity cost matters more than the rate alone. This is the key difference between someone who buys a house and someone who builds wealth.
Wealth is not just about what you pay for debt. Wealth is about how much money you keep and grow elsewhere while sheltering yourself from unforced errors. So, what should you actually do? Here's a realistic framework you can consider. Don't chase rates. Focus on total cost. Mortgage rates are just one part. The total interest paid over the life of the loan, the price of the house, your income stability, and what you do with the money you would otherwise invest, those matter more. Time horizon beats interest rates. If you're buying, ask, will I be here 10 plus years? Because refinancing to cut rates a little makes sense only if you plan to hold the mortgage long enough to recoup fees and benefits. Think about opportunity cost. Instead of obsessing over whether rates dip by 0.3%, ask, what am I giving up by tying up my savings in this deal? Because that's where millions of viewers get blindsided. Mortgage rates dropping below 6% sounds like a watershed moment, and maybe it is for the housing market as a whole, but lowering rates by a fraction does not automatically make buying a house a good decision for every individual. Your financial success will not be decided by the mortgage rate you sign. It will be decided by how you manage risk, how you use liquidity, how you invest the difference, and how you time your life, not the market. And that's far more important than any headline about 6%. If this changed how you see mortgage rates and housing decisions, hit that like button and subscribe for more personal finance reality checks that actually affect your life.